Are you drowning in information trying to figure out cryptocurrency trading?
Scrolling through countless videos, wishing someone would just distill the absolute essentials for getting started.
You just hit the jackpot. This deep dive unpacks the wisdom from the most comprehensive YouTube guides we could find, cutting through the noise so you can get the foundational knowledge you need to begin your crypto journey. Welcome to the deep dive. Today, we're cracking open a stack of source material presented as thorough guides for understanding and engaging with the world of cryptocurrency. These aren't just quick tips. They aim to give you a solid grounding.
Yeah, our mission is basically to go through these sources and pull out the most important nuggets, everything from the absolute basics of what crypto fundamentally is, right through to market dynamics and the practical steps for investing or trading.
Think of this as your accelerated path to getting informed, straight from the material you've shared. Let's get this deep dive started. So first things first, what even is cryptocurrency? The sources make it super clear. It's not just, digital money like your bank app shows.
Exactly. The big difference they hammer home is control and decentralization. With your bank, well, the bank controls it. Government can step in. With crypto, you control your wallet. No bank, no government can just block you.
Which sounds great, but there's a catch, right? That recovery phrase?
Oh yeah, huge catch. Lose that phrase, that string of words. Your crypto is gone. Poof, forever. No helpline, no recovery process. It's all on you.
Because the records aren't in one place.
Precisely. They're spread across this huge network of computers, the blockchain. It's public too. Anyone can look up transactions on the blockchain explorer. Transparent, but anonymous-ish.
And computers help run this network because they get paid in crypto.
That's the incentive, yeah.
Yeah.
It keeps the network secure, decentralized, no single point of failure. That's key. And it's why those central bank digital currencies, they're not really crypto because they're still centrally controlled.
Makes sense. So it's not all Bitcoin then?
And not even close. Thousands out there. Broadly, the guides say you've got coins and tokens.
Coins like Bitcoin, built from the ground up.
Right. Big effort, unique code. Then you have tokens, often built on existing networks, like Ethereum. Think of Ethereum like a platform for creating tokens, apps, websites, that kind of thing. Resist censorship, too.
Okay, so what makes them valuable? Is it just hype?
That's the big question.
Yeah.
The sources say, well, partly it's like fiat money, right? Dollars, euros. Their value is based on trust in the government.
And that trust maybe isn't what it used to be.
Exactly. Governments print money, causes inflation, your savings lose value. Crypto's value, they argue, comes from what it does. Bitcoin. Limited supply, like digital gold. Having events cut new supply. Demand goes up as fiat looks shaky.
Ethereum.
Pure utility. You need ETH, the currency, to do anything on the network, pay gas fees for transactions, use apps. Big players like Visa, even the ECB, are testing things on Ethereum. That's real adoption driving value.
But the prices are crazy volatile. Why?
Because it's still so new. Like, nobody really knows the true long-term worth yet. Its potential is massive, revolutionary even, so investors get emotional, rumors fly, prices swing wildly.
Is it mostly used by criminals? That's what you hear sometimes.
That's mostly a myth, according to these guides. Sure, some privacy coins exist, but Bitcoin, it's public. Actually easier to trace than cash sometimes. The real risk isn't crime, it's investing, especially with borrowed money leverage. Don't do that.
So the core advice is?
Only invest what you are absolutely 100% prepared to lose. Treat it like risk capital.
Gotcha. Okay, so moving beyond the basics, the sources talk a lot about why people are even looking at crypto, tying it to bigger economic trends. Fiat debasement.
Yeah, this is fundamental. Look at the US dollar's purchasing power over the last century. The charts are, frankly, startling. It's lost so much value.
Because governments keep printing more.
Pretty much. To pay debts, fund spending, stimulate economies, whatever the reason, more money chasing the same goods means each dollar buys less. Inflation, debasement.
And this isn't just a blip, it's a long-term thing.
That's what they call a secular trend, a long one-way street. Fiat value goes down over decades. So people look for assets that don't do that. Gold, stocks, real estate. And now, maybe Bitcoin, because it has that fixed supply.
So you have these big secular trends like debasement and then smaller cycles within them.
Exactly. Cycles are shorter-term inflation cycles, debt cycles, even the Bitcoin 4-year halving cycle. Trading might play the cycles, but long-term investing. You focus on riding the big secular waves. The argument is fiat is trending down. Hard assets like Bitcoin are trending up, relatively speaking.
And Bitcoin is framed as more than just money, like a network.
A monetary network, yeah. Or hard money. Fixed supply, decentralized, can't be easily messed with. That's why it's seen as a potential store of value, unlike fiat, which leaks value over time. Some even call it a world index on financial health.
How does adoption fit in?
It's another huge secular trend. The charts show crypto adoption tracking the early internet or mobile phone adoption curves. Still early days, potentially massive growth ahead.
So you're investing in the network growing. Metcalfe's law.
Spot on. More users equals exponentially more value. That's the conviction for long-term holders. Ignore the daily price swings. Focus on the network growth. Relax, kinda.
Okay, so how do people actually do this? Investing versus trading.
Big difference. Investing. Buy and hold. Longer than a year usually.
Yeah.
Aim for long-term growth. Lower tax rates on gains typically.
Trading.
Short-term. In and out. Trying to catch small moves. Market cycles. Higher tax rates. Much harder to do consistently. The mantra is time in the market, not timing the market.
What about earning returns, like staking?
Yeah, on networks like Ethereum, you can stake your coins, lock them up to help secure the network and earn rewards, kind of like interest or dividends.
This links back to tokenomics, right? How the coins work.
Totally. Bitcoin, fixed supply, decreasing inflation. Many altcoins.
Yeah.
Ongoing inflation, sometimes high. This can fund development but also dilute value, especially if early investors with cheap tokens sell their staking rewards. You got to check the supply schedule, vesting, all that stuff.
And stable coins, are they an investment?
Not really for appreciation, no. They're pegged to fiat, like $1. Useful for holding value on chain. Some newer ones try to pass on the interest earned from the reserves they hold, which is kind of neat, something banks often don't do.
Okay, practical steps. Where do you buy this stuff? Exchanges.
Yep, exchanges are the main gateway. Centralized ones, CEXs like Coinbase, Binance, Bybit, OKX, they're the easiest way to get fiat money in and out.
But there's a trust issue. They hold your crypto.
That's the crux. You're trusting them. Look for exchanges that prove they hold your assets 1.1 with proof of reserves. It's become crucial after, well, disasters like FTX.
What about decentralized exchanges, DEXs?
Those let you trade directly from your own wallet, like MetaMask or Phantom. No intermediary holding your keys. You are in control.
So custody is the big decision. Trust an exchange or trust yourself.
Fundamentally, yes. Exchanges are convenient, especially for trading. Self-custody, using your own wallet, ideally a hardware wallet, like a ledger that's maximum security for long-term holding. Keys offline, almost impossible to hack remotely.
Makes sense. What about figuring out how much to invest?
Okay, super important first. Personal finances, income, expenses, debts. Figure out your excess capital.
And before investing?
Rainy day fund.
Yeah.
Absolutely essential. 6-12 months of living expenses, liquid cash, safe place. Only invest capital beyond that. Money you can truly afford to lose.
How much crypto then? What percentage?
Total personal. Depends on your goals,
Yeah.
your timeline, your risk tolerance. Saving for retirement in 30 years. You can handle more volatility than saving for a house down payment in 3 years. Look at risk-adjusted returns maybe.
Like the Sharpe ratio.
Yeah, stuff like that. Historically, Bitcoin's risk-adjusted returns look pretty good, apparently. Even a small allocation, like 1-3% of your total portfolio, could be a start if you're cautious. Diversify.
And the best way to invest regularly.
Dollar cost averaging. DCA. Simple. Effective. Invest a fixed amount, say $100, every week or month. Doesn't matter if the price is up or down.
Buys more when low, less when high. Averages out the cost.
You got it. Removes emotion, builds consistency. That's how wealth grows for most people. Steady additions over a long time, not trying to get rich, quick trading.
Wow. Okay. We covered a ton there. From what crypto is, the big trends, the risks, the tools, and how to build a personal plan.
Yeah, these guides really packed it in. Understanding the potential, the secular trends, the cycles, and the practicalities. It's a lot, but crucial.
Definitely feels like having this knowledge is key to even approaching this market. We really hope this deep dive has been super valuable for you listening.
Absolutely. If you found this useful, maybe share it with someone else who's curious about crypto. Spread the knowledge.
And please help us out. We're trying to get Le Podcast de Philippe to 1,000 subscribers. Your support honestly makes a huge difference and lets us keep doing these deep dives.
So, final thought, building on all this. Given the data on historical returns, the adoption trends, the fiat situation, is it actually becoming riskier not to have at least a small, responsible allocation to this asset class tailored to your own situation than to ignore it completely?
Something to chew on. Definitely food for thought as you figure out your own path in the world of digital assets.